Hello friends and welcome to my YouTube channel Simply Stocks, and today I'm going to talk about dishman carbogen, a stock for which a lot of request has come in to put a video. So here it is. What does the company do and whether you should invest into it? Let's understand. Let's get started. First of all, a disclaimer that this is not a stock recommendation. People taking any position into any share that I talk about should do that with their own due diligence and research, and I'm not in favor or against any company that I talk about. Before I talk about Dishman Carbogen, here's a small request that kindly support me on Patreon. And on Patreon, I have put up a lot of articles on different types of stocks, markets, and market analysis, etc. So even if you support me through a $2 investment, it will help me a great deal in continuing with the channel on YouTube, as research and analysis of stocks takes a lot of time and effort. So it's just a request for that. Thank you. Now about the company. So Dishman Carbogen was acquired by Dishman Group in 2006, and it is a leading service provider to pharmaceutical companies, and they provide drug development and commercialization services. So they provide all the help needed for development, R&D, etc. of drugs, and to distribute the drugs in the market. They have clients globally and not only in India. So they have clients in Europe, US, Central and South America, and it's part of the Dishman Group. So there are a number of divisions that the Dishman Group has, and Dishman Carbogen is one of them. The market cap of the company is only 1200 crores. If you look at the financials of the company, then the sales have gone up by around 22% to 520 crores, whereas the PAT has declined by around 32%. The debt has reduced over time. High other expenses has gotten a lot of, you could say, high other expenses is the reason why the profit has declined so sharply, and probably they need to control that. And add to that, there is low margins. So the margins are, say, return on equity of only 4%. Operating profit margin is okay, solid at 23%, but it could be better, and I've seen better OPMs for other pharma companies. So the performance of the stock, well, similar to what the profit numbers show, the stock is down around 72% in the last 1 year. The bottom line decline is really hurting the stock, so they have to turn that around. Even though there is a sales growth, if the profit growth doesn't come in, then the EPS will not come in at that level, and the stock will always look expensive. So the EPS growth has to be there. And I have said that many times. Just to add a sentence on this, that whenever you're trying to buy a stock, then you have to look at the profit growth along with the sales growth, because if you don't see that for 4 or 5 years, then there is no guarantee that the stock would perform on the profitability front over the next 3 4 years, and you might be buying on hope. So but take that into consideration. So here in Dishman Carbogen case, the profit has declined, and that has really spooked the markets. Institutional investment and promoter holding combined is 85%, which is pretty good. So only 15% free float is there. But if the numbers doesn't improve, then you could see that declining as well. The return ratios are very low, and in that regard, with the return on equity of only 4%, if the company doesn't do operationally well, then the return ratios would not come back, and people have options of buying other stocks which have better return ratios and better margins to go for. Then why would they take a risk with a less than 2000 crore market cap company? There is firm sales growth. I agree with that around a 20-25% sales growth is pretty good. But if again the return ratios and profitability is not there, people will try to stay away from such companies, especially in such a scenario where a lot of external factors just come about from here and there every 6 months or so. As we have had the virus issue right now, we have had the Palakot incident about a year back, we have had many other incidents like uh, there are issues which are external issues. The China issue of 2016, if you take that into consideration, the small cap sell off between 2018 and 19, which took every stock down even if they were performing. So there are a lot of other issues that people have to deal with while investing into stocks. They won't get into companies which have low return ratios and low profitability. Uh, If you look at the technicals of the stock, then very weak on charts, currently at all-time low. As I say, the 200 DM is around 154 rupees. It is less than 100 rupees at the moment, and you need to buy only above 105 rupees. And price tells a lot of stories. So only buy above 105 rupees. If the stock is falling like 9 pins at the moment, there could be other things, and I'm not saying I'm confirming anything at the moment, but after what has happened with Manpasand beverages, and it has happened to me as well. I was invested into the stock when that carnage happened, and that fraud came into light. After what has happened with Manpasand, with Vakrangi, with other stocks, with the issues of auditors, I have decided that, and this is my personal opinion, that in my opinion, if the price keeps going down, even if the numbers are fine, then there could be other issues with the company. I'm not saying that there would be here, and this is just pure speculation. You can do your own research, but if the price doesn't come up, basically you're buying the stock for a rise in prices, and if the price doesn't go up, you're not making profits. So technically you have to look at the stock that it has to be solid, it has to be above 200 DMA at least for you to get into it, even for a long term investment basis. And right now the stock is well below the 200 DMA. The stock is just catapulting, and against the markets it is catapulting down, whereas the markets in the small and mid cap arena has done well before this news of the China scare came out. So what needs to be done? I believe that you need to avoid this stock at all cost and keep track of developments, keep track of what they do on the bottom line, what are the other, you can say, corporate changes, if anything that is taking place. Are they getting into better deals, or in which they'll earn a lot over a period of time? And are the numbers changing? Are the things changing on the ground? If they are not, then don't get into such a company. Let numbers improve first. Do not get into the stock purely because you believe that the numbers would be good. Let 2 quarters numbers be exceptionally good, and only then try to get into such a stock needs to turn bullish technically as well. So basically, if the numbers starts to look good, or if there are some news midway through the quarter, then the stock would go above the 150 160 range. So do not hurry to buy into it. Let the stock go up 50%, not a problem with that, 50 60%, because then you will be sure about the strength of the stock, and fundamentally the stock would look good, and you could see 200 250 levels easily, rather than buying today and then regretting it, that oh no, the numbers are not coming and the numbers are becoming worse, or something else comes up in the company. Then you are just you are invested in the company, so then you cannot just get out in losses, and then the losses will keep on increasing. So rather than trying to be cute and buying early, you need to wait and let the numbers come in, let the stock do well, and only then get into the stock. So this was my video on dishman carbogen. Please like and subscribe my channel, hit the bell icon so that you can get my video straight away when I post it. Thanks a lot for watching.